Good morning. It's Friday, the 28th of February, the last day of the month of February, being the second month of the year of 2025. And of course, time is flying. And this is Govindraj Ethiraj, headquartered and broadcasting and streaming as always from Mumbai, India's financial capital, the top stories and themes. The markets go flat in search of new signals. A personal story in the life sciences innovation journey from Dr. Reddy's. India's G20 Sherpa Amitabh Kant says Mahindra and Tatas will give Tesla a run for its money. Brace for one of the warmest months of March ever. The new US Gold Card replacing the EB5 visa. What will be the outcome? Air cargo is growing, but growth rates slow down in January.
This is the Core Report with Govindraj Ethiraj.
The markets are flat as they come. The Indian markets seem to have joined the flat earth society, it would appear, so narrowly were they trading on Thursday. The question really facing investors and traders is at what point will that recovery come? It's tough to say, because you have to remember that the current fall is not triggered by a sudden cataclysmic event like the 2008 financial crisis or even the COVID crisis of 2020, rather a steady but consistent fall that started at the end of September 24. At this point, the Sensex and Nifty have fallen about 14%, while the Nifty 500, which is a broad index, has fallen about 20%, which takes it into bear territory. The only consolation is that in the post-liberalization years, the markets have usually tended to bounce back, though sometimes the recovery can take long, including years. On Thursday, the Sensex swung around but eventually closed up only 10 points at 74,612, while the NSE Nifty 50 index was almost unchanged at 22,545. We spoke of the Reserve Bank of India loosening its grip on non-bank finance companies, allowing them to borrow more easily from banks, reducing risk weightages for more consumer loans, obviously in an attempt to increase retail demand or increase consumption. Shares of non-bank finance companies were up, with stocks like Bajaj Finance and Bajaj Finserv up about 3%. Shriram Finance from the Nifty 50 index was up about 5%. Other stocks like L&T Finance and Mahindra Finance were also up quite sharply, according to Business Standard. The broad market continues to be under pressure, though. In this phase, the BSE mid-cap index fell 1%. The small cap was down almost 2%. In an interesting and somewhat candid admission, Chris Wood, the global head of equity strategy at Jefferies, told Business Standard he was likely to chase China rather than India in the short to medium term. Now, he's of course echoing what many fund managers globally are saying, and more so after that DeepSeek moment, and that a good part of the current rally in Chinese stocks is driven by and comprised of tech and AI-linked stocks. And that's the piece of the pie investors want right now in China. Wood told Business Standard he remains structurally bullish on Indian equities, but that's from a long-term perspective. Translated, he's waiting for prices to fall further or a DeepSeek-like moment to happen in India too. If someone has no exposure to Indian stocks, they should start buying now. When the tide turns, the rally would be very sharp. And that said, and this is the important part, listen carefully, he says, we are still in a sell on a rise market in India and not a buy the dips. Now, that statement, of course, reflects what we see happening every day in the markets, or almost every day, which is markets rise in early trade and then start cooling off or falling off. Wood says he's bullish on sectors like travel and tourism, which he thinks can give superior returns. He also said that while Indian market valuations were very high at its peak, the massive selling by foreign investors has surprised him. He summed up the two phases of foreign institutional investor selling. First, to rotate money towards China, as it started unveiling, I'm guessing that's the reason, a series of stimulus packages which we saw late last year. And second, after DeepSeek. He also pointed out the failure of India's private sector to drive a broader capex cycle, which, as we know, is largely driven by the government. There is a growing doubt of the lack of capex coming from the private sector, which has been disliked by the markets, according to Wood in that conversation with Business Standard. Gold prices are steady. If you're a gold price watcher and a careful one at that, then do pay close heed. Gold prices have fallen 1% to their lowest level in more than a week on Thursday as the US dollar firmed up. Spot gold was down 1% at $2,889 an ounce on Thursday, its lowest since February 17th, Reuters said, adding prices had hit a record, or rather reminding that prices had hit a record of $2,956 per ounce on Monday. And the rupee is steady. The rupee did not move much on Thursday, thanks also to some intervention by the Reserve Bank, which overall seems to have returned to a more active role after perhaps staying more neutral for several weeks earlier. The rupee ended at 87 rupees 20 paise against 87 rupees 21 paise in the previous session. Traders told Reuters the intervention was not just to stabilize the currency but to also curb large one-way moves, thus reducing any speculative trades against the rupee. Analysts also told Reuters that the prevailing global challenges outweigh the existing advantages for the rupee and the downside bias remains for the currency. Asian currencies were also weak, with the offshore Chinese yuan slipping to about 7.27 to the US dollar, according to Reuters. It's a warm March ahead. India could see one of the warmest March months on record, with above average temperatures likely to hit yields of the maturing wheat crop, according to Reuters. Now, the likelihood of that warm March in a context of a weak northeast monsoon has already been flagged, and we talked about it earlier. India is the world's second biggest wheat producer and has had now 3 consecutive years of poor crop yields since 2022. Higher temperatures could hit yields for the 4th year now, and thus obviously reducing production. Officials told Reuters that March is going to be an unusually hot month, and both the maximum and minimum temperatures will remain above normal for most of the month. And if you're in Mumbai, where temperatures have been routinely hitting 38 degrees plus in recent days, well, you can imagine the rest. Day temperatures are expected to start rising from the second week of March, and by the end of the month, maximum temperatures could exceed 40 degrees Celsius in many states. Remember, we're talking March and not May or June, which is traditionally considered peak summer. India's wheat-growing states in the central and northern belts are likely to see those jumps in temperatures in the second week of March, with temperatures rising about 6 degrees Celsius above average, according to those officials. And that's exactly what we've seen in Mumbai as well, about roughly 6 degrees above average. So March could not or may not be conducive for wheat, chickpea, and rapeseed, and crops could experience heat stress, those officials said. Winter crops, like wheat, are planted from October to December and require cold weather conditions throughout their growth cycle for best yields. Indian wheat prices have already jumped to a record high this month thanks to dwindling supplies. India's pharma industry braces for change. India's contract drug makers want the government to lower regulatory hurdles even as it moves faster on clearances for raw material imports. India's Contract Research Development and Manufacturing Organization, or CRDMO as it's called, the sector is at an inflection point with the potential to grow sevenfold to about $22 billion by 2035, according to a report by consulting firm Boston Consulting Group released at BioAsia in Hyderabad earlier this week. Globally, the market for such contract manufacturing stands at about $140 billion. India's contract drug manufacturers have gained from global companies' efforts to diversify their supply chain, particularly after the pandemic, and a US bill that prohibits or would prohibit federal contracts with certain Chinese biotech firms on national security grounds, according to Reuters. The problem, of course, is that India's policies are still catching up. Approvals take a long time, and regulatory demands tied to some raw material imports mean Indian firms need 8 to 15 days to initiate projects, which their Chinese peers could do within 3 days, according to a senior partner at BCG's healthcare practice, again quoted by Reuters. At a session at BioAsia that I sat through, Piramal Pharma's chairperson Nandini Piramal publicly lamented the lack of customs warehouses at right locations, logistics costs, and not enough cold storage units apart from delays tied to the clearance of certain raw material imports. While India has done well on contract manufacturing, despite all the hurdles, this also puts the spotlight back on innovation and why India lags here. Now, there are many reasons which range from regulatory factors to perhaps the lack of sufficient trained scientists and patient capital to fuel long-term bets of the kind the life sciences industry would want. At a CEO panel at BioAsia on Tuesday, I asked G.V. Prasad, co-chairman and managing director of Dr. Reddy's Laboratories, how he viewed the challenge of innovation in life sciences and what held back Indian companies. I also asked him in the conversation how the late Dr. Anji Reddy, the founder of Dr. Reddy's Laboratories, could have viewed the same challenge.
I represent Dr. Reddy's Laboratories unit here. I want to give you a little bit of history of our drug discovery efforts. We started drug discovery in 1994 for the first time in India by Reddy company. We went on that journey for about 15 years. We tasted a lot of success. We outlicensed compounds with MHCs for clinical development. But in the end, we spent about $150 million and realized that we were not going anywhere in the research that we were doing, and we kind of wound it down 2009-10. And after that, we looked at incremental innovation, actually taking the existing molecules, making that better through formulation innovation. We got 6 products up and we launched them in the US. Unfortunately, we had to struggle to get reimbursed. And that whole financing was not adding up, and then we had to sell that business. And after that, we started a services company around 2000 called Origin Discovery Technologies. And that somehow morphed into a oncology research company with a fairly deep pipeline of about 10 small molecules in immuno-oncology and in the clinic at various phases. And we still don't have visibility to it now. This is almost 30 years of effort. So I just want to highlight how difficult it is to innovate and innovate in a system which is very nascent in its evolution for drug discovery. And that's the reason I said it's a little presumptuous to say global leading the global charge on innovation from India. It's going to happen, but not. The other part is you asked for what could be the moonshot goal for innovation. The government has already declared they want to invent or discover 100 NCEs, NMEs by the year 2047. This is a stated goal now. So that itself should spur a lot of innovation. Well, having said that, as an industry, we are very good in process innovation, process development. We actually are leaders in API development, in generic product development, biosimilars, services, and we've really become a force in that. And we shouldn't discount that. Of course, innovation is a much bigger challenge, but I think we should be proud of what our industry has achieved in the last few decades. And certainly, we are globally competitive. India is known as a reliable source for all these areas. And that, is something we all should justifiably feel proud. Now, going to innovation, innovation is not a linear journey from API to generics to innovation. Like people say, moving up the value chain, but this is not a continuous value chain. It's a very different business. The risk profile is very different. Generics, you have a large number of small packs. Each application maybe 3 million, 4 million, and 5 million. But for a drug to see the market is hundreds of billions of dollars, $1 billion plus. So it's a very different game. We can do some initial discovery, then partner, then develop it. Many ways to get there. But no Indian company has the wherewithal financial to take a drug, discover it, and take it global across all phases of development. It's just very large. And a company which is, most of our companies are valued on the profits they make. The valuation is a multiple of your earnings per share. So if you look at that from that perspective, the more you spend on research, the less you the value, because nobody gives value to the pipeline in this country. So there are so many such obstacles. But again, the price is worthwhile. The price is worthwhile. If you have a successful drug in the market at a global level, not at the Indian level, the payoff is amazing. It transforms the company from where it is to multiples of what there it is. So it's a difficult challenge. It requires a lot of effort, like as Ram Charan said, focus, tenacity, persistence, ability if you take intelligent risks. And in spite of all that, there is a lot of uncertainty. In spite of all the artificial intelligence people are talking about, this human body is not well understood. Protein to chain of well speak, FI the contracts. And how many companies have there the thought observe the failure of a phase 3 now? And that I think is a defining challenge for us. It's a great aspiration to have. Certainly the high time for it. India is on the rise, financially stronger. There's a lot of risk capital available. Talent is coming back, and we do need it back. So with all this, I think it's a worthy challenge. It's a moonshot. Safety like landing is a moon. And if you say what is purchase, it is discovering a drug in the labs in India and launching it globally. That should be the moonshot they should take. And the government said they should store 100 price. But the challenge is not in discovery, it's in develop phase 1, phase 2, phase 3, as a global track.
Let me interject a quick question before I come to Dr. Somnath. So, what would Dr. Ranji Reddy have been thinking in '94 when he took on that chapter?
Well, he's written his biography, soul story of Tesla. He was so passionate about the story. He was a scientist. He was an entrepreneur. He had that, passion for science. The biography is called Unfinished Ajarya. And here I'm also 64 now, and I'm still struggling to complete the unfinished Ajarya. So,
But, so I say that he did not have the same sense of concern about, let's say, quarterly results and such pressures as you have today.
no, so for him, it was his life story, passion. But he wanted to go take a breath from the story to global thoughts. He didn't need it to be done internally in one partner. Unfortunately, he didn't see it in his lifetime. I hope I can.
India should take a page from the playbook of countries such as China and Australia if it wants a larger share of the global clinical trials market, according to healthcare experts at BioAsia. Data from consultancy firm PwC said that as of 2022, India held an 8% share in global clinical trials compared to China's 29%, the US 25%, and 38% for the rest of the world. A BCG partner said that there's a lot to learn from what other countries have done to make them clinical trial destinations. Clinical trials are used to evaluate the safety and effectiveness of new treatments. China apparently saw an increase in innovation after easing regulations, while Australia benefited from offering tax incentives. Indian electric cars fan moment. Yesterday, we spoke about how Tesla could have a tough time in at least the earlier phase of its India entry, given the fact that some of its models that are likely to come to India are going to obviously be priced pretty high. That's one. Second is that it's not going to be a grand entry. There is no real service network, and the likely sales of those cars will happen as of now only in Mumbai and Delhi. On the other hand, Indian manufacturers are responding already. Mahindra, for example, and its electric origin SUVs, the XEV9e and B6, have already secured something like 30,000 bookings, which is a little less than 1/3 of the entire market for 2024. Interestingly, India's G20 Sherpa and former Niti Aayog CEO Amitabh Kant says that India has a very good chance in the electric vehicle sector. He said that domestic automakers like Tata Motors and Mahindra will ensure that Tesla does not dominate the Indian market. And he also said that not only are Tatas and Mahindras and their products' prices very competitive, he revealed that he himself had switched to an electric vehicle and he's just booked a Mahindra electric vehicle, which brings us back to those 30,000 bookings, and presumably he's one of them. Speaking at a business standard event, he also emphasized the need for India to become a global champion in EV manufacturing, particularly in two-wheeler and three-wheeler segments, where it has a strong export base as well as a strong presence in India. He also said that every Indian should move to an electric vehicle and the government should not buy any fossil fuel cars, and the government should become the first driver of EV adoption. The Trump Gold Card. US President Donald Trump, as we discussed yesterday, has announced a new immigration scheme, the Gold Card, which offers wealthy foreign investors a fast track to US citizenship for about $5 million or about 43 crore rupees. And this is set to replace the existing EB-5 visa, which requires about $1 million of investment and the promise of creating at least 10 jobs in the United States. The EB-5 was created in 1992 and could grant green cards for those who invested in economically distressed zones called targeted employment areas and to create jobs for American workers. I reached out to Varun Singh, director of XIPHIAS Immigration, who's helped to settle about 10,000 families outbound. And I began by asking him whether the gold card would work for Indians in the larger context of where Indians were headed, particularly in 2025.
Today's update has really set back a lot of turmoil in the Indian investors because it was not expected that it will go fivefold. See, this 5 million investment USD, this is not that open, but in New Zealand and in Australia and in few European countries, the passport, the citizenship option is already there up to that price. Okay, but US for Indians, it's a top dream, and setting up 5 million USD as a benchmark. Anyways, in India, none of the investors can do this from India. It's impossible. The LRS, the RBI, it never allows you to transfer more than 250,000 for investment or buying a property. There is no such option available in the RBI portal. for the bankers to go and then take an eligibility to transfer your fund from your bank to any US entity. It's impossible. There is no option, sir. Right now, in last 10, 15 years, the property appreciation which has happened in India, so a lot of families, they made money from their parental property and for the capital gains. So this may impact for the expats and NRIs who are living outside US and outside India. For them, it will be an easy option if this looks in a technical and the feasibility of the financial arrangements. Otherwise, this 5 million part, being an Indian, sitting in India, you cannot do this. There's no way that you can get into this $5 million golden card. This may affect and this may open the other verticals for other golden visas. Now, the most prominent is the Dubai. Now, Dubai, everyone is choosing. Now, this as an hop, as a one step ahead for taking your next milestone. So, Dubai enables you to have your residency and then enables you to have a freedom of legality and also the accounting. And that helps you to have your next milestone. So, looking if US dreams is there, then it has to go via Dubai or it has to go via Europe green cards or golden visas. So, Europe golden visas are very common in India and Portugal, Greece, Malta, Cyprus. These countries are very popular countries in last 5, 7 years. And the investment starts from 2.5 crores Indian rupees. This is within the LRS scheme. So LRS scheme, even a husband and wife can do 500,000 in a one financial year. And next financial year, you can do another 500,000. So this March closing and April closing becomes a very prominent months for all our investment consultant and investment industry because of this restrictions. So I believe this is going to open a new vertical. He has made a new benchmark. The benchmark is very high. And of course, the rich and wealthy Indians or immigrants can only migrate to US. And parallelly, they will also see this is for the investment, but there were a lot of interviews happening in terms of the talents and the skill sets. So talents and skill set visas are already there. The categories are already there. So this move has been done to fix the deficit of the federal government in US. And that's how they can raise a lot of capital. And this is the trend in entire Europe. You see Caribbean countries and they're such a tiny countries. They have billion and billion trillions of economy because people wants to buy their passport to have a tax haven and to have a tax benefit.
The earlier structure of EB5 that involved, it was an investment, as in you invested and you created a business, which is conceptually different from saying that buy a green card for $5 million. So my question is, the Indians who want to move to the US, that you've seen, would more of them want to actually set up businesses, or were they only using this route because that was the only available route?
This was the only available route because this was a passive involvement. Okay, now the passive involvement, the only two condition was that you need to have 10 employments to be generated. Either you can go and open your business and hire 10 people and reach that benchmark of investment in your company, you can apply for your green card directly. But that is a very tedious process and it takes its own time. And if you see the collateral of this hiring and then setting up, all this takes little time to get your processed into the green card. So a lot of Indians and other families, they used to see this as a very defined channel because the investments were going on a approved investment projects. Now these investment projects are already having a buffer of employments generated and your share of your EB5 is a very small portion. So this was a very easy route. This was a predefined and this EB5 is running for last 30 years. In India, it has become famous in last 10 years because everyone wants to send their kids for F1 visa for studies. But now the trend is changing that, okay, even after sending out for studies, your child has to struggle for 7 to 10 years to get the green card. And even that is not sure. So that's why the families, they started putting money back in that country because this is going to come back. After 6 years, 5 years, you have a condition that your employment is generated, your investment is invested. Now you can get the money back. And this is just a 5 years, you get the money back, you got your green card, your price for your green card became zero. This is how a lot of families from South India, from Gujarat, they opted this as an investment, as an FD for 5 years, and your return is your green card, not your monetary returns. So monetary returns is there. But of course, this is setting up a new benchmark, Govind.
If you look at what's the environment today, where let's say the United States is obviously becoming a more difficult country to migrate to, and I'm talking about legal migration, or for that matter, even H-1B visas. and other countries, including Europe, tightening as well. Canada is tightening, Australia is tightening. So, how are you seeing the environment right now? I mean, where do you see people going? Where do they want to go? What is feasible?
The scrutiny is very important, Govind. There are a lot of any changes which people take, misuse the clauses and the clauses in system. If immigration process and protocols are becoming strict, it is very good for us as a professional because we see it as a very defined and robust option. Right now, if you see last 6 months, 1 year, every family has struggled to get an appointment for a simple tourist visa or any visa. And there was a flaws for keeping up to the agents to get the appointment. See, illegal migration is a different story. I don't understand how it works because it's all through the border and the leakages through the borders, filtration through the borders, not through the system. System that never allows you to file the application without having your police clearance certificate. If you have done any cases or you have some issues, you can't pass your scrutiny or the due diligence. So I see it as a profession as a very good thing that yes, reforms and changes and technical infusion should happen because we see there are a lot of gray areas which needs to be fixed and the technology can help to reduce the turnaround time and the experience of the users and the families who are living there on a dilemma about the delays of the visas. So according to me, this migration option happening right now, this is a very positive sign and looks positive.
How do you see 2025? I mean, what kind of trends are you seeing as things stand? And from what we see happening around in the world, do you see less Indians attempting to migrate even for, let's say, the Dubai kind of locations?
See, Govind, in last 15 years, this trend is not going to stop. Last 140 years, 150 years, it has never stopped. It will never stop in future also. So this migration is a trend. People, family, companies, they move for their better life, for better career, for better earning. This is something which is happening from ages and decades. Only the thing is, if the benchmarks they are setting up little different, so things will change. 2025 is already in last 1 month, a lot of changes have happened. Greece have changed, Spain have changed, Italy have changed. There are a lot of changes happening and we are seeing these changes and on a very positive note. And I see it as also this is a very challenging year because a lot of setbacks in terms of people who are financially ready. Now they cannot go because of uncertainties. But then we have to give a clarity, confidence, and that is how we take the families on board. And this is our main that we do a right guidance so that you don't go land up in a wrong operation, in a wrong consultation. So this is how things are very important. But yes, they choosing a right consultant and choosing a right program, your preference, your priority defines the entire pathway. So it's not just for the sake anyone can put 50 crores in US unless you have your preference for it. This is how I believe this is a preference and behavioral and psychological driven industry. And of course, geopolitical infusion is also drives the industry. So things will change when the good governance comes, good leadership comes, then things will look positive.
Right. Varun, thank you so much for joining me.
Thank you so much. Thank you. Nice talking to you.
Air cargo growth slows down. The International Air Transport Association has released data for Jan 25 global air cargo markets showing that there has been a roughly 3.2% increase in demand compared to Jan 2024. And of this, about 3.6% is for international operations. This also makes it the 18th consecutive month of growth. On the other hand, while January signified 18 months of growth for air cargo, the 3.2% figure is a moderation from the double-digit figures and peaks of 2024. Similarly, IATA says that while yields that were still above the Jan 2024 levels saw a 9.9% or close to 10% decline from December, as cargo load factors also declined by an average of 1.5 percentage points. Now, this could also be because of a high base, but it could also signify some shifts or imminent shifts in the way global cargo is likely to move in coming months. But also remember that there was a lot of stacking up ahead of potential tariffs by the United States on countries like China. And before we go, here's some feedback. We do try and bring in feedback every Friday, but we could not do that last Friday because it was a totally packed show. Now to return, Manjunath GC says, great news briefs to start the day. Thanks, core team. SP Singh says, let Chinese electric vehicle giants be allowed to bring their fully built up high-end electric cars and SUVs into India with the same terms and conditions offered to Tesla. Then we should have a free market play between Tesla, BYD, and Indian car makers, and consumers in India deserve choices. A very interesting and useful point. Thank you very much for that, SP Singh. Chitranjan Sarvesan says it's honestly like rubbing salt in the wound. When the Prime Minister met with Elon Musk, he literally skipped a meeting with the Prime Minister in India last year, went to China on the same day. That's Beijing. It also shows how little he thinks of the Indian market for his EV cars. And Zafar Khan says, thank you, Core. Well, that's it from me and the Core team for this Friday morning. See you next week. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in. And thank you once again for listening.